Why is Brent oil dropping today? Crude oil supply shock 2026, Brent oil forecast next week, oil price technical analysis today, Hormuz Strait oil impact, oil freefall $80 level, Brent crash support zone. Brent crude just did something it hasn't done since March. It collapsed through $80. Not a gentle dip. A 4.6% single-day freefall. And right now, almost every trader I speak to is convinced this is the start of a sustained peace meltdown, that the Strait of Hormuz reopening is a done deal. They are piling into short positions exactly where the trap is set. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, with precise entries, stops, and profit targets, so you're not just watching, you're executing with a plan. This is your instant market verdict. The session bias today is clearly bearish, a continuation of that strong sell that dominates the weekly, daily, 5-hour, and 1-hour trends. But we are not blindly chasing. We are fading the oversold snap into resistance, because the structure is brutal and the momentum is extreme, yet the positioning is dangerously one-sided. There is a single invalidation level that flips this entire bias, and you need to write this number down. If Brent manages to recover and print a 4-hour closeback above $81.73, the entire bearish structure resets. 81.73 is your pivot, your line in the sand. Below it, bear zone this market. Above it, the trapdoor swings the other way and shorts get obliterated. Right now the herd is short, heavily short, and the CCI on the 4-hour chart is sitting at negative 252, an almost historic extreme. When the crowd is this positioned and the tape is this stretched, a relief rally isn't just possible, it's how liquidity is engineered. So I want you to be the one harvesting that move, not becoming its fuel. Let's go deep into the technicals, from the top down, so you see the full architecture of this move. On the weekly chart, the trend is a strong sell, and the MACD is accelerating negative with no sign of a bullish cross. The weekly average directional index is above 41, which tells you this is a trending beast, not a choppy sideways mess. That means counter-trend bounces will fail fast unless something fundamentally shifts. Now drop to the daily chart, and the picture gets even sharper. Brent has sliced through every single major moving average as if they weren't there. The 5-day moving average sits at 85.27, the 10-day at 88.72, the 20-day at 93.19, the 50-day at 95.21. All of them are now way above us, acting as overhead supply walls. But the one that really matters is the 200-day moving average at 83.94. That level was support for months, and now it has flipped into a brick wall of resistance. Price closed below it with conviction, and until we reclaim it, the directional lean is lower. The daily RSI is at 29.4, deeply in the seller's grip, but not yet plumbing the sub-25 desperation zone where monster bounces are born. The daily MACD is minus 4.05, still widening, and Williams' percent range is pinned at negative 95, screaming oversold on any traditional metric. Here's what most traders miss. Oversold in a strong trend is not a buy signal. It's an acceleration signal until the momentum diverges. And right now, on the daily chart, I do not see any hidden bullish divergence yet. Price is making lower lows, and the oscillator is making lower lows. There is no structural reason to call a bottom. Only a tactical one. Now let's move into the 4-hour and 1-hour execution lenses. The 4-hour chart is a cascade. Price smashed through S1 at 81.73, then S2 at 80.30, and is now hovering right above the S3 support at 78.20. That 78.20 level is critical. That's where the market paused in previous swings, and it represents the last bastion before a potential air pocket down to the 75 or even 74 zone. On the 4-hour MACD, I can already see the histogram bars shrinking slightly, which tells me the momentum of the sell-off is decelerating. This is the very early whisper of a possible positive divergence brewing. Price might make one more marginal low while the MACD histogram puts in a higher low. That is the hidden divergence that could ignite a sharp short squeeze. Keep your eyes locked on that signal over the next 2 sessions. The 1-hour chart is equally instructive. It shows the final leg of this freefall, with a series of lower highs and lower lows. The moving averages on the 60-minute are completely bearish, but note that the stochastic has already curled up from oversold territory, sitting at 43, and the Williams percent range has moved off the absolute floor. That means short-term traders are already trying to pick a bottom. I call this the relief rally trap. The initial bounce will likely get sold into the first resistance pocket. And that first resistance pocket is the old S2 turned resistance at 80.30, then S1 at 81.73. The pivot point for today is calculated at 83.83, which coincides quite beautifully with the 200-day moving average area. That is the ultimate bearish re-entry zone if the market truly wants to stay within its trend. I will give you trade plans around every single one of these levels. Before I get to the setups, we need to connect this price action to the fundamental driver, because oil is the geopolitical heartbeat, and right now that heartbeat is erratic. Yesterday's core news was simple and explosive. Brent dipped below $80 on fresh hopes for a full Strait of Hormuz reopening. There are whispers that a deal is being mediated, that tanker traffic could normalize within weeks, and that the supply disruption premium built into crude is evaporating. The market has taken that headline and run with it, pricing in almost 2 years of normalized flows. But here is what's priced in, and why the low 80s bet may be betting too early on pace. The Strait of Hormuz is a choke point for roughly 20% of global oil supply. The geopolitical track record of such deals collapsing without warning is long. A single drone strike, a single failed negotiation, and that risk premium snaps back in hours, not days. This is not just an oil story. This is a macro pulse. Lower oil prices are already triggering a move in bond yields and easing inflation expectations, which paradoxically is giving the Nasdaq and S&P a small tailwind. If crude stays depressed, the dollar might lose its commodity inflation bid, creating a risk-on crosscurrent in equities. But if Hormuz talks fail, oil rockets, and suddenly the stagflation fear returns, crushing risk assets. So the crosslinkage is clear. Watch the S&P 500 E-mini futures. If they rally further and oil stays heavy, the market is buying the peace narrative. If equities start to crack alongside oil, it's a broader demand fear story, and that's a completely different beast. My 1 to 2 week directional lean. We remain bearish under the 83.94 200-day moving average, but I expect a sharp, violent mean reversion bounce from the $78 to $76 zone, driven by a geopolitical headline reversal or simply by position exhaustion. The exact event that invalidates this longer-term bearish bias is a daily closeback above 83.94. Until then, we sell strength. Do you think Brent will hit $75 this week? Comment yes or no right now. I am tracking consensus in real time, and your input shapes tomorrow's analysis. Most people skip this section. They hear the setups and they click away. That's exactly where the money is made, so keep watching. I am handing you 3 fully mapped trade strategies, each with a different risk profile, so you can align the trade with your own psychology and account size. I will give you the exact entry conditions, the exact stop loss, the target 1 and target 2 with risk-reward ratios, and the precise level that voids each setup entirely. And after the active trader strategy, I want you to type your Brent range for tomorrow in the comments. Let's see who is aligned with the institutional flow strategy 1, the sniper. This is the conservative, high-probability setup for those who wait for confirmation and refuse to chase. Here is the exact trigger. You wait for a relief bounce to sell into resistance. The entry condition is a 1-hour candle close below $81.70. That is the old S1 support now acting as resistance, just beneath the pivot and the 200-day moving average. You do not enter with a limit order blindly. You wait for price to rally up into that zone, show a clear rejection, ideally a bearish engulfing or a long upper wick, then enter on the close below. Your stop loss is placed at $84 exactly. Why? Because 84 sits just above the pivot and above a minor structural resistance, giving the trade breathing room while keeping the risk defined. Your take profit 1 is $79, capturing the move back to today's breakdown area. Take profit 2 is $78.20, right at the S3 support. The risk on this trade from 81.70 to 84 is $2.30. The reward to target 2 is $3.50, giving a risk-reward ratio of 1 to 1.52. That's a solid institutional asymmetry. The setup is void if Brent prints a 4-hour close above 81.73 with conviction. That would show buyers have absorbed the selling pressure at resistance, and the bear thesis is temporarily broken. The sniper, conservative, entry, 81.70, 1H close below after bounce, stop loss, 84.00 take profit 1, 79.00 take profit 2, 78.20 risk, reward, 1:1.52 are invalidation, void if 4H close above 81.73 strategy 2, the active trader. This is the standard mean reversion fade for traders who want to engage more dynamically with the downtrend. The entry condition is a pullback to the broken S2 support, now resistance, at $80.40. You are looking for a lower time frame rejection there, a 15-minute bearish pin bar or a sudden volume spike fading the bid. Once you get that, you execute short. Your stop loss is placed at $81.80. This is just above the S1 level of 81.73, which we already established is the bearish invalidation pivot. The logic is tight and clean. Take profit 1 is $79, right into the current zone of the low. Take profit 2 is $78.20, the S3 floor. If you capture TP1, immediately move your stop to break even at entry, letting the second half run risk-free. The risk on this trade is $1.40. The reward to TP2 is $2.20, giving a risk-reward ratio of 1 to 1.57. The setup is void if the market fails to reject 80.40 and instead climbs through 81.73 on the hourly chart. That tells you bears are losing control of the microstructure. Type your Brent crude range for tomorrow's session in the comments right now. Give me your high and your low. This is where we test conviction and see who's tracking the same levels. The active trader, standard, entry, 80.40, 15M bearish rejection, stop loss, 81.80 take profit 1, 79.00 take profit 2, 78.20 risk, reward, 1:1.57 are invalidation, void if 1H close above 81.73 strategy 3, the aggressor. This is the high-risk, momentum chase short for traders who can handle a tight stop and are willing to ride the very edge of the waterfall. The entry is market on breakdown, meaning you short right here at current price, 79.45, on a clean break of the psychological 79.50 handle, or you wait for a pullback to 79.70 and hit it with a limit sell, but only if you see fresh selling volume. Your stop loss is brutally tight at $80.20. That's just above the S2 resistance and the round number 80. The logic is simple. If the market reclaims 80, the immediate freefall liquidity trap has failed, and you do not want to be in that trade. Target 1 is $78.20, the S3 level. Target 2 is $77 exactly, an extension that aligns with a previous monthly pivot from earlier in the quarter. The risk is 75 cents. The reward to target 1 is $1.25. Giving a risk-reward ratio of 1 to 1.67. That is acceptable only if you manage the position actively. This trade is for those who can lose small, accept a high probability of being stopped out, and manage risk aggressively. It is not for the timid. The setup is void immediately if a single 15-minute candle closes back above $80.10. I mean it. If you cannot watch the screen, do not take this trade. The aggressor, high risk, entry, 79.45 market, 79.70 limit on volume stop loss, 80.20 take profit 1, 78.20 take profit 2, 77.00 risk, reward, 1:1.67 are invalidation, void if 15M close above 80.10 risk management. Pulse. This is non-negotiable. Never risk more than 1 to 2% of your account on any single trade. Do not hold positions through high-impact news like a sudden Hormuz headline or an unscheduled OPEC Plus statement. Stops are not suggestions, they are your survival. The only way to trade the next massive move is to stay in the game. Now let's close the loop and set you up for tomorrow. The single most critical level to carry into the next session is $78.20. If Brent holds above it on a daily closing basis and the 4-hour MACD builds that hidden divergence, you have the makings of a powerful short squeeze that targets the 80.30 then 81.70 zones within days. If 78.20 fails, and I mean fails with volume, the door opens to 76, then 75, and the freefall accelerates as trapped longs finally capitulate. Tomorrow's wildcard is twofold. First, any new Hormuz headline will override everything, so watch the news feeds like a hawk. Second, we have the usual crude oil inventory data that could add demand-side fear or relief. I will be here breaking down the exact levels for that session, and I will also do a full cross-asset breakdown showing you how this oil move is shaping the S&P 500 gamma structure and Bitcoin's correlation. If you want that full breakdown, that video is live right now. Tap the end screen, smash the like button if this gave you a clear, institutional-grade trading plan. Subscribe, hit the bell, and I will see you right here for the next session, before the next explosive move.